The first and the foremost rule of any strategy designed to follow the trend is to determine the direction of the current market trend. Trader can do this in several ways, for example, by using technical indicators. Double barrel gun trading strategy uses moving averages to define the direction of market trend. As you know, moving average is the most common, easiest and most reliable tool for determining the direction of trend. For this purpose, double barrel gun trading strategy uses a pair of long-term moving averages, EMA 200 and SMA 200. The first question you may have is why I chose 200 but not 100 or 50 as a parameter of moving averages. The fact is that moving averages with these parameters are very often used by long-term investors on daily, weekly and monthly charts. They use a fairly simple rule. If current market price is above the 200 periods moving average, then the current market trend is up, and vice versa. Take a look how the price behaves when it approaches the SMA 200 and EMA 200, built on the daily chart of the currency pair Euro-US dollar. I tried to use these moving averages at shorter time frames, and found that here, they work well not only as a trend indicator, but also as a support and resistance lines. You can see this in several examples below. Please note the behavior of the price line in relation to the lines of the indicator. Here's how they look on the charts. This is an hourly chart of the currency pair, Euro versus Japanese yen. The next example is 10-minute chart of Brent crude oil. And finally, the last example here is 1-minute chart of the currency pair, British pound versus US dollar. In all examples listed above, two moving average lines with the parameter of 200 time intervals are used on the charts. As a matter of fact, in front of you is a complete trading strategy. You can open positions in the direction of the current market trend every time when the price approaches the moving averages with a parameter of 200 time intervals, and then bounces off those lines. In this case, the stop-loss order should be placed slightly below or above the moving averages. The second question that you may have is why I use two lines instead of one, and how they differ from each other. As a matter of fact, you can build a moving average almost in any program of technical analysis. It is considered to be the most popular trend indicator. Depending on the formula used for the calculation of an indicator, all moving averages can be divided into several types, such as simple, or SMA, exponential, or EMA, weighted, or WMA, displaced, or DMA, and others. Double barrel gun trading strategy uses two most common types of moving averages, simple, SMA, and exponential, EMA. The simultaneous use of two lines instead of one increases the reliability of the trading strategy. The second valuable quality of moving average is that it can be used as a line or area of support and resistance. So, trader can place his stop-loss orders above or below the moving averages. The wider the area of support or resistance formed by two lines, the less likely that the stop-loss order set by trader will be triggered. Now, we can move on to the next rule of the strategy. It's time to learn how to define the reversal of trend. As you may know, the second important signal that any moving average generates can be found on the chart when it crosses the price line. I think that every trader has heard such expressions as golden cross and dead cross. What do these signals mean? Golden cross signal means that a downward trend has ended. It occurs when the price line breaks through the moving average from below. Accordingly, death cross signal means that an upward trend has ended. It occurs when the price breaks through the moving average from above. The problem is that after such a signal, there is not always a change of trend in the market. In order to reduce the number of false signals, I added a short-term moving average EMA20 to the strategy. It is plotted as a blue color line on the chart. The simultaneous use of moving averages with different time interval parameters 220 allows the trader to receive the same golden cross and dead cross signals, which indicate a change in the direction of current market trend. The short-term moving average is quite sensitive and provides much more reliable signals about the changes in the direction of the current market trend, as well as signals indicating the end of correction. See how the change of a downtrend is indicated in this chart. In front of you is a 10 minutes chart of currency pair US dollar versus Japanese yen. The end of the downtrend occurs when the short-term moving average with a parameter of 20 time intervals crosses upwards a pair of long-term moving averages with a parameter of 200 time intervals. On the next slide, you can see a 10 minutes chart of another currency pair, US dollar versus Swiss franc, where a change of an uptrend is indicated. The end of the uptrend occurs when the short-term moving average with the parameter of 20 time intervals crosses downwards a pair of long-term moving averages with the parameter of 200 time intervals. Thus, if the market has formed an uptrend, then the following two conditions should be met. 1. The price chart should demonstrate a series of clearly visible rising highs and rising lows. At the same time, each subsequent high and low should be higher than the previous one. 2. Long-term moving averages with the parameter of 200 time intervals must be sloped upwards, and the short-term moving average with the parameter of 20 time intervals must be located above the long-term moving averages. Accordingly, if the market has formed a downtrend, then the following two conditions should be met. 1. The price chart should demonstrate a series of clearly visible falling highs and falling lows. At the same time, each subsequent high and low should be lower than the previous one. 2. Long-term moving averages with the parameter of 200 time intervals must be sloped downwards, and the short-term moving average with the parameter of 20 time intervals must be located below the long-term moving averages. Like any other trend-following strategy, double-barrel gun strategy makes money during uptrend or downtrend market phase, and loses money during sideways market phase. Therefore, when the market forms a sideways trend, trader is not recommended to open any positions using the rules of this strategy. How can the trader determine the beginning of the sideways trend? There are two additional rules that can help you to solve this problem. Rule number 1. Pay attention to the slope of the two long-term moving averages. If they are moving horizontally, this can be the first sign of the formation of a sideways trend. Rule number 2. Pay attention to the relative position of two long-term and one short-term moving averages. If after formation of the first signal of trend change, during the same trading day, a new signal of trend change is generated, then this can be a confirmation of the fact that the market has indeed started a consolidation. In this case, trader should wait until the price moves up or down, and goes beyond the boundaries of the price range formed in the last day or two. Only after this breakthrough, the long-term moving averages will form a clearly visible upward or downward slope, and there will be new opportunities for opening positions.